Hello, we're here with Ken French, and as most of you are probably aware, Ken has worked closely with Dimensional for many years now and has also co-authored numerous research papers with Gene Fama. Ken has more recently become the Director of Investment Strategy for Dimensional. We're fortunate to have him here and hoping to have him share some insights with us. First, Ken, I want to ask you a more personal question. You've taught at Chicago, and then Yale, and then MIT, and now Dartmouth. Does this reflect a restless intellect or just some inner compulsion to keep moving northeast?
No, it really does come down to a geographic preference. I absolutely loved working at the University of Chicago. Really enjoyed living in that area, but we far prefer living up in New Hampshire.
Sounds like a final move.
My wife hopes so.
Could you describe in a little more detail this new role at Dimensional? You've been designated as Director of Investment Strategy January this year. What does that mean?
Yeah, basically what I'm doing is I have a foot in both camps. I continue to teach at Dartmouth. I teach finance at the Tuck Business School. But the other foot is here with Dimensional in Santa Monica. And what I'm trying to do is have the best of both worlds. I absolutely love being an academic. I love teaching. I love doing research. But over the years, I've been working with Gene Fama, with Dimensional, and it turns out I love doing that as well. And when David and Rex approached me with the possibility of taking over this new role, it didn't take a lot to persuade me. The only challenge is basically, can I accomplish both the academic work and the Dimensional work? And fortunately, David and Rex and the other folks here at Dimensional have been flexible enough. My dean at Tuck has been flexible enough, and I'm hoping to be able to pull off both. So far, it seems to be working great.
How did the relationship with Dimensional first start?
I've been working with Gene Fama for, we're getting old, about 20 years now. And Gene has been on Dimensional's board pretty much since it was founded. Gene had been working with Dimensional on fixed income products. He and I started doing a bunch of research together, and one of the papers we worked on was about the cross-section of stock returns, sort of the paper that talked about the value effect and the higher returns on value stocks versus growth stocks. As we were writing that paper, before it was even published, David Booth realized, gee, this is a really interesting idea. Maybe we could build some portfolios around it. And as a result, Gene and I started to develop, working with David and Rex and the other folks here at Dimensional, we developed some value products, and my role has expanded from there over, it's about 15 years now.
Turning to some investment issues now, we're hearing a lot about momentum these days. What does the research on momentum show you? How do you interpret it?
Momentum is a tough topic, and the reason it's a tough topic is my overall view of markets is one of equilibrium. Some might say market efficiency. I sort of avoid that word only because it's people misinterpret market efficiency. And by talking about market equilibrium, that gives me the opportunity to define my terms in a way that people won't misinterpret. So I have this equilibrium view of the world. And what that means is there's competition everywhere. People are fighting to take advantage of whatever opportunities arise. So basically, you don't get huge opportunities anywhere. The evidence on momentum is pretty compelling. Jagadish and Titman wrote a paper back in '93 that shows there's strong momentum. And let me define what momentum is before I go much further. Basically, momentum says stocks that have done well for the last 6 months, the last 12 months, relative to other stocks. The stocks that have done well over the last 6 to 12 months tend to continue to do well for the next few months. The stocks that have done poorly for the last 6 to 12 months, they tend to continue to do poorly for the next few months. And this was originally, Jagadish and Titman presented this. I think we could say they actually discovered this. There's been an enormous amount of research since then. It seems to be a very robust finding. And the reason this is troubling from an equilibrium perspective is there's no easy way to explain what's going on. At the same time, this momentum phenomenon is persistent, phenomenally consistent. At some point, you got to say, look, It seems to be there. It's everywhere we look. It's backwards through time. I got to accept it at some point.
Is it big enough that Dimensional should be applying some sort of momentum approach in their strategies?
Well, it's useful to step back and ask, how has momentum affected our returns in the past? If you think about our classic portfolio, a small value portfolio, for example, that portfolio is essentially betting against momentum. Think of the stocks you're buying in that portfolio. You're buying small stocks. You're buying value stocks. In both cases, what that means is you're buying companies that have just gone down. Well, what momentum would imply is you expect them to continue to go down. That's not what you want to be buying when you're buying a portfolio. Think about the stocks you're selling out of a small value portfolio. You're selling the stocks that have just gone up. You're selling the stocks that have become large by going up. You're selling the stocks that have become growthy by going up. In other words, you're selling the winners out of your portfolio. Momentum says, gee, those stocks are going to continue to win. You don't want to be selling those. Well, if I were running a small value portfolio on my computer, the way we do academic research, that stock fell into my buy range, let's buy it immediately. I'm really betting against momentum. I get crushed by the stocks as they continue to go down. I lose by selling the stocks as they continue to go up. If we look at what Dimensional's live portfolios look like, they have some bet against momentum. In other words, we are buying the losers and we are selling the winners, but not as much as I'm doing in my computer. Why? Basically, Dimensional's, one huge part of Dimensional's value added is the patience that they use when they trade. What we're doing now, what we're hoping to do now, is actually immunize the portfolio against momentum. What do I mean by that? We're basically going to put in, you think of it as a filter, it's a bit more sophisticated than that, but essentially a filter that says, let's wait until the effect of momentum has been washed out of the stock that's moved down into our buy range. Let's wait until the effect of momentum has been washed out from the stocks that have moved up into our sell range. Once they've damped out, okay, now we'll sell them. Once they've fallen down to their whatever the bottom line is going to be, okay, now we can buy them. Basically, we're going to put that momentum filter in to try to immunize, to not take a negative bet against momentum.
Is momentum essentially a small stock phenomenon, or is it dispersed throughout the market?
It's definitely much bigger among small stocks. And it's also much bigger among the losers than the winners. So yeah, there's probably a little drift up in the winners, but not nearly as much as the drift down among the losers. So momentum's bigger among small stocks, and it's bigger among the losing small stocks than among the winning small stocks.
How about taxes, a subject we're hearing a lot about these days? Could you summarize how Dimensional approaches the issue of tax management?
It's useful to think about what it is you are trying to do in a tax managed strategy. Because often you'll hear people talk about minimizing taxes. That's not the goal. The goal is to maximize the after-tax value of your portfolio. And what that means to us is it's a variety of trade-offs. So if I were to think about the tax-managed mutual funds or a tax-managed separate account for a high-net-worth individual, what are we doing in there? Basically, we're trading off several different things simultaneously. First and foremost, remember this is dimensional. So number one, we want to keep transactions costs under control. Okay, we're not in love with any stocks. We don't hate any stocks. When we buy and sell stocks, we want to make sure we do it efficiently. So we want to control transactions costs. Number two, again, this is dimensional, so we want to make sure we have nice, well-diversified portfolios. So our second concern is, are we delivering well-diversified portfolios? But then on top of that, we may have desired style tilts. For example, we may say, okay, for this portfolio, it's a small value portfolio, and we need to make sure that we're tilting toward value. If it's a small value portfolio, we need to make sure we're tilting toward small. It could be just a plain vanilla market-wide tax managed portfolio. There we want to make sure we don't have much style or size tilt at all. We want to get back to the crosshairs, something close to the market. All right, so where you have this trade-off. We've got transactions costs, we've got diversification, We've got value versus growth style tilts that we're shooting for. We've got size. Okay, those are sort of our standard considerations. Now for a tax-managed portfolio, we have to add on worrying about capital gains taxes and worrying about dividends taxes. So with the capital gains taxes, we have to worry about short-term gains and we have to worry about long-term gains. What we're trying to do when we're managing these tax-managed portfolios is trade off all of those issues simultaneously. And the big challenge is to figure out, gee, how much transactions costs am I willing to take to avoid realizing a capital gains? Or how much style drift am I willing to have in exchange for not harvesting some capital gains? Or, okay, if I avoid dividends, what that's going to force me to do is have a more concentrated position than I might have otherwise have because I'm not going to buy stocks that are paying dividends. How am I willing to make those trade-offs? What our portfolio decision system's doing is explicitly making those trade-offs simultaneously. And the beauty of this portfolio decision system is it's not just limited to tax-managed portfolios. It can be applied all over the world. In fact, we've developed a product, a portfolio in Australia, the Australian Core Equity product, based on this algorithm that essentially targets the ASX 300, which is the basic Australian portfolio or index portfolio, that has a bit of style tilt, a bit of a value tilt, that has momentum control in it, and yet tracks the index relatively closely. And the most interesting thing down there is instead of trying to avoid dividends, as we do here in the States for tax-managed investors, because they have a particular arrangement with taxes in Australia on dividends, we actually seek dividends down there. So what we're going to say now is, go back to my trading system. The portfolio decision system allows me to immediately change the dial and say, you know, dividends, we used to hate dividends. Now, we just don't like them very much. So when I start thinking about trade-offs between, am I willing to take dividends or do I want to diversify more? Now I'll choose, let's diversify a lot more than I used to because the cost of dividends is a lot lower than they used to be. Okay, so it's nice. It allows me to adjust these things on the fly. Very flexible system.
Juggling all these trade-offs sounds like a huge puzzle. Is this the kind of difficult problem that academics enjoy sinking their teeth into? Is this the
I'm not
way
sure
investment strategists can help investors in the real world?
I'm not sure this is what we do best, but it sure is fun. That's the luxury of being an academic. I have the opportunity to sit around and mull this stuff over, to think about it, to read the literature, to try to figure out what is it that people have thought about. It's not like I have to invent everything myself. We have, you know, there's thousands of us out there trying to think about these problems. And not only that, but all of us are out there distributing the answers for free. There's no proprietary information among academics. Our goal in life is to discover stuff and brag about it. So what that means is all the information is out there. All we have to do is sit around, talk to our friends, talk to our colleagues, read the journals, read the working papers. Other people are working on this stuff, and we try to put it together and make sense of it. And it's not as if we've got the final answer here. We continue to work on the algorithm, try to improve it. For example, they changed the tax laws. We have to step back and ask, okay, what are the implications of this? How should we react to that? We've been struggling with that for the last couple of weeks, and we're quite confident we have a pretty good answer at this point. We know what we want to do next.
Interesting. You and Gene wrote a paper over 3 years ago now about the equity risk premium. Could you summarize what your findings were and maybe bring us up to date on any new thoughts you might have?
If you think about the equity risk premium, the expected return on the market relative to the risk-free rate, that is like the gravitational constant of finance. It is the number that everyone would like to know. If you think about investments, the number one answer, number one number for all investment decisions is what's the overall expected return on the market. If you think about corporate finance, the number one thing you would like to know is what's the rate that I should be using to discount my projects. If you think about somebody planning to retire in 20 years, what expected return should they be using when they figure out what's the appreciation on their portfolio going to be? All of those things, the answer to every one of those questions is whatever the equity risk premium is. So that's the number one number you'd like to know in finance. Well, it turns out that number is incredibly hard to get your arms around. We get to observe the realized return. We've got plenty of numbers going all the way back to the 1700s on the realized return on the market. The trouble is, it's an incredibly noisy number. What we did is we said, wait a minute. If I were to assume that the earnings price ratio was a stationary variable, in other words, it keeps coming back to the same average value over some long horizon, then I can expect the growth in the earnings over that long horizon should be roughly the same as the growth in the prices. In other words, if the earnings price ratio is 10 right now, and I expect earnings to grow by 20%, and now I expect the earnings price ratio to be 10 100 years from now, then I must also expect prices to grow by 10% over that same period. So what we basically said was, look, if I'm willing to assume that either the dividend yield, dividends divided by price, or earnings divided by price, revert back to some long-term mean, then I can look at the expected growth in earnings or the average growth in earnings and use that as an estimate of the expected growth in price, which is really the question, the hard part of estimating the equity risk premium. So that's all we did. We calculated what's the average growth in earnings over some long horizon and use that as a better measure, a more accurate measure of the expected growth in price than the actual growth in price would be. And it turns out when we do that, it's not like there's something hard and fast here. You don't want to say the right answer is 3.426, but it's probably an equity risk premium on the order of long-term 4%, something like that. So if you said to me, what's the expected return on the market? I'd say, okay, whatever the risk-free rate right now is, perhaps 2.5%, plus the 4% equity risk premium. Add those together, I'm getting an expected return on the market of somewhere around 6.5%. I don't want to imply that, I'm trying to communicate the notion that these numbers are not very precise. But they're a lot smaller than you would get if you were to look at just the average return over some long history.
This issue of long-run earnings growth and dividend growth, do you find any relation between company dividend policy, their payout policy, and stock returns?
You got to step back. And you really need to clarify, do you mean dividend policy or do you mean investment policy? Think about from the classic M&M, Miller and Modigliani perspective. What they argued was dividend policy doesn't matter. So if you're just asking me, does it matter if the firm chooses to pay out dividends or not? Well, as long as they don't change their investment policy, I think they take away my PhD in finance if I don't say, nope, dividend policy doesn't matter. What matters is investment policy. Now, if I choose to not pay out in dividends and instead keep the money inside the firm, change my investment policy, making more investments, the effect of that will be, we're going to get more increased, an increase in earnings that we wouldn't have had otherwise. So by not paying out dividends and as a result altering my investment policy, making more investments, the effect will be an increase in the earnings growth. Remember, stock returns are being driven by risk. So it can't be, management's doing something crazy, so the expected return from now till forever is lowered. No. When the news comes out that management's doing something crazy, prices will fall, and then you'll go back to whatever your normal expected rate of return is, given that firm's level of risk.
Another popular phrase we're hearing a lot these days is behavioral finance. What does that phrase mean to you?
Behavioral finance, that's people who have gone crazy. No. I actually split behavioral finance into two parts. There's the pure behavioral part of behavioral finance. That part to me is incredibly interesting. And for example, there's a bunch of papers by Brad Barber and Terry O'Dean that look at what investors actually do. And they are really shedding a lot of light on individual investors' portfolio decisions, how they can be improved, just how they react to a bunch of things. It's fascinating, fascinating, classic, great empirical research. The other half of behavioral finance is more challenging. Finance is all about expected returns, trying to establish pricing models, different expected returns because of differences in risk and stuff like that. How can I explain that given people's behavior, given the mistakes that people seem to make consistently in the way they behave? That's quite different from asking, given that specific type of behavior, what do I predict about the stock market? Ask guys in behavioral finance, what do you think the implications of academic research are for investing? What should individual investors do? Very few of them will say anything except individual investors, they ought to hold nice passive portfolios. Typically, they ought to hold index portfolios, which I find fascinating. Okay, I mean, here are all the guys. Wall Street is saying, it's all about behavioral finance. We can add value because we know about the biases in individual decision making. And the guys who are actually doing the research, they're coming back and saying, given everything we observe, for the typical investor, they ought to be simply buying a nice index portfolio or some structured portfolio of that type. So there's a lot that academics can say about portfolio management. Most of it is not good for active managers.
So how does Dimensional distinguish itself? How do we add value relative to all the other participants in the money management industry?
Our equilibrium view of markets, market efficiency, if you will. What that gives us is a phenomenal opportunity that other firms don't have. What do I mean by that? Well, first, think about what it means. It says we don't love any stocks. We don't hate any stocks. It's not as if we've spent months and months studying some companies and decided, those are the ones that are undervalued. We better buy them today before the price goes up. Or those are the ones that are overvalued. We better sell them today before the price goes down. Nah, that's not the way we manage our portfolios. What we say is, hey, those are small stocks. We got 3,000 small stocks. We need some of them. Which ones do we buy? Well, whichever ones happen to be presented to us in an opportunistic way. We're out there equally indifferent among 3,000 companies. If we get the opportunity to buy one at a particularly good price, we'll buy it. Now, these companies have wandered up. We've succeeded. They were small companies. They've become big companies. And now, we want to keep this a small stock portfolio. We've got to sell them. Which ones do we sell? Again, we'll eventually sell them all. It needs to be a small stock portfolio. But we'll sell them in a nice, patient way. We'll sell them as the opportunities arise. So that gives us a phenomenal advantage. The biggest advantage comes when we start talking about tax-managed portfolios, for example. Because here, think about all these trade-offs. Some active manager has gone out and identified, I got 6 undervalued stocks. I need to buy those. And now I've got 4 stocks in my portfolio that are overvalued. I better sell them. They're not going to be worried about the tax consequences of that. We step back and we say, wait, no. That's a short-term gain. If I sell it today, I got to pay 40%. If I just wait 3 more months until it turns into a long-term gain, I cut my tax bill in half. Let's wait. So the fact that we have this equilibrium view of the market and we're not trying to add value by identifying over or undervalued stocks, that frees us up to do enormous things, both on the trading desk and over here in research where we're trying to engineer sensible portfolios to improve our clients' investment experience.
So what research papers are you working on now?
So what are we working on? I've continued to work with Gene Fama on almost everything I'm working on. We're working on a paper right now that basically we're trying to understand how firms choose or what firms choose to do when they're making financing decisions. In fact, that's the title of the paper right now. We may revise the title and change it to something that's a little more illuminating, but we like short, punchy titles. So the current working title is Financing Decisions. And what we're doing in this paper is basically arguing that companies issue a heck of a lot more equity much more often than people think they do. What we're finding is that roughly 70 to 72% of the firms issue equity in any particular given year. If you ask the typical academic, what do you think? How many companies are issuing equity each year? I don't think many people would say, gee, we expect somewhere around 70%. And what we find is, if we actually look at the change in the shares outstanding, we're seeing something on the order of 70% of the firms over each of the last 10 years issue equity in any given year. And they're very persistent. If a firm issued equity last year, it tends to issue equity again this year. But not only that, but if a firm was a net purchaser, instead of issuing, they repurchased their shares last year, they also tend to issue shares this year. So it is not the case that most firms are doing nothing or most firms are repurchasing. Most firms tend to be issuing equity every year.
Ken, thanks very much for sharing your insights here with us today.
No, it was a pleasure. Thanks for having me.